Hi, I'm Lorna Illingsworth, a mortgage advisor for Protection Investment Southampton, and today we're going to look at getting a mortgage if you're a director of a limited company. Yes, you can get a mortgage if you are a director of a limited company. You may, however, have to provide more proof than someone who is employed. This is because your income is directly influenced by how well your business is doing. If you're a director of a limited company, you will be able to apply for the same mortgages as if you were employed or self-employed. But how much you can borrow will depend on how that lender assesses your income. It will also depend on how much percentage you own in the company. Because it can be more complex applying for a mortgage if you're a director of a company, you should seek advice from a mortgage broker who is experienced in this area and will know what lenders to apply to. If you're a director of a limited company, how you're assessed for a mortgage will be different from lender to lender. Typically, most lenders will use your director's salary and dividends. If you have reduced your salary and dividends to minimise your tax liability, you may not be able to borrow as much as you thought. Typically, a lender will lend 4 to 5 times your income. So if you're looking to apply for a mortgage, you may need to pay yourself more in dividends or salary. Some lenders will also consider your share of the company's net profit. This can help increase how much you can borrow. Like those who are self-employed, a lender will likely use an average of the last 2 or 3 years. But if you've had a particularly good year, you could apply to a lender who will take the most recent year, allowing you to borrow more. As a director of a limited company, you will need to provide your personal tax calculation for the last few years, like those who are self-employed. But you will also need to provide company accounts too, so the lender can evaluate the sustainability of your business moving forward. You will also need to provide bank statements for the last 3 months. Like those who are self-employed, you will need at least 1 year's accounts for your business. It's unlikely that you will find a lender willing to lend to a new business that has been trading less than a year. However, it is recommended that you have around 2 to 3 years of business accounts, as you'll have more mortgage options. The exception to this being if you were a sole trader previously and have set up a limited company for tax purposes in the same line of work. It's very common to go from a sole trader to trading as a limited company, likely because your profits were getting higher, so becoming a director, taking a basic salary and paying dividends could be more tax efficient. But it could reduce your options for mortgages. Some lenders will view this as a new business and need 1 year's business accounts. However, a lot of lenders will accept that this is a continuation of your previous business. They will want to see proof that you've stayed in the same line of work and see at least 2 years of trading history before you switch to a limited company. They will likely assess you as a sole trader for your application, either using the lowest figure or using an average of your last 2 years' tax calculation. Some lenders may use the most recent year's figure. Not only does being a director of a limited company affect how you're assessed, but how much of the company you own will also affect how a lender will assess your income. Typically, if you own 25% or more, you'll be treated as self-employed, allowing you to use your salary, dividends, and share of net profits for a mortgage application. If you own 25% or less, you will be assessed as employed, meaning that your dividend payments may not be considered, reducing how much you can borrow. If your business profits have gone down in the last year, it may be trickier to get a mortgage. Most lenders will allow a small reduction, but if it appears there's a trend of declining profits, it may be unlikely to get a mortgage. Lenders want to see that your business is profitable and sustainable. Some lenders will be understanding if there was a reason for the decline, such as during COVID, lenders were understanding of the reason for a reduction in profits. Lenders will need a good explanation though, and may require an accountant's projection to show profits are likely to increase. Yes, there are a lot of lenders who will accept figures from your latest tax calculation and business accounts. This may increase how much you could borrow compared to if a lender used an average of the last 2 or 3 years. If you were employed when you originally applied for your mortgage and have since set up your own company, you may be confused with how and if you can remortgage. Whether you can remortgage to a new lender will depend entirely on your income. If your income has decreased, you may not be approved for a remortgage. If this is the case, a product switch with your current lender will be more suitable. But if your income is around the same or has increased since you first applied, then you should be able to remortgage, which may be beneficial if another lender has better rates. If you're a company director looking to get a mortgage soon, get in touch with us on 02380 668 407 or visit our website at www.pilsouthampton.co.uk.